All right, everybody. So welcome, Don Wenner here, and we're having our monthly, right about monthly. We do these webinars. We kind of share some of the updates going on here at DLP, what's happening in the world of real estate, and get a chance to chat, answer questions. So, reminder as we dig in, feel free to type in any questions you have for myself. My associates Larry and Rich are on here with us as well. So type them into the Q&A function or chat function, and we will tackle those questions throughout or at the end. So with that said, let's dig in here. So first, for those, and I'm looking at a list of names here, and definitely some new faces, new names. So I'm going to give a quick little overview on myself and DLP before we dig into a little bit about what we do and some of the updates to our investment strategies. So the slide you see here on the screen is a little overview of DLP. So DLP Real Estate Capital is our parent company that sits atop of all of these business lines, these business units you see on your screen. But really our engine here at DLP, what drives our growth, was driven our 60+% growth we've had every year for the past 15 plus years, is DLP Capital Partners. And that's our private investment funds that you're going to hear about here today. The capital that you invest with us is what allows us to deploy that capital into our businesses, from acquiring and then managing and doing the construction, asset management on our real estate portfolio, as well as lending capital and supporting other real estate operators with their investments through DLP lending, as well as our elite membership and DLP Realty as well. So all the companies work very much together, fully vertically integrated. The center of all of our organizations and our success over these past 15 years has been our people. We have built, I can say with confidence, I know many of you work in and or own successful companies. I can tell you with confidence, I'd put our culture and our people up there against any organization and say confident we have the very best people, and certainly the best people for our culture and the goals we have set for our company. We're a purpose and mission driven organization. Our purpose is to dream, live, prosper, which is what DLP stands for, passionately creating prosperity through real estate. We have 10 core values that drive all of our day-to-day decisions, drive the types of people we bring into the organization. And hopefully, as you get to know us, you'll be seeing and feeling these values throughout each and every team member you work with here at DLP. So I'm going to get in here and start off a little bit with talking about impact investing. And I believe all the companies that we run here at DLP and all the efforts that we do are virtually all impact investments. And that's at the core of what we're doing. And I'm going to explain a little bit about that, explain the importance of the investments we make and the crises that we're focused on making an impact on. And then I'll explain a little bit about the investment funds that we run and how, if you're interested, how you can participate. For those of you already invested with us, I'll give you some updates to the performance, as well as what properties are on the horizon that we're acquiring, and hit on a couple other highlights, and then we'll open up to questions here. So first, I want to define impact investing, because you're going to be hearing more and more of this term here from myself and from DLP, as we're putting a significant emphasis throughout our organization on making sure each dollar we deploy, each of our capital we deploy, is making an impact. And impact investing are investments made with the intention to generate positive, measurable social and or environmental impacts, along with a financial return. DLP strives to impact two crises that we're facing here, certainly around the world, but right here in the USA and the communities most of us live in as well. The affordability crisis of workforce housing and the jobs crisis here in America. The fact that more and more jobs are being deleted or erased due to technology more than anything else. And we strive to make an impact on both of these challenges through our investments that we make collectively with our investors. We're able to make an impact on these two crises while delivering consistent returns to investors, providing, preserving, and creating safe, clean, and affordable workforce housing, growing businesses, and in turn creating jobs, and helping our residents create prosperity and wealth. So we call it our 4X bottom line, and that all interested parties, from our investors to the operators we support to the assets and investments that we're investing in, and then the residents living in those investments all benefit from this investment approach, this strategy. I'm going to dive in here specifically with really expressing. And I know every probably person here has heard about, and it's probably not a surprise when I say there's a crisis of workforce housing in America. Nobody's probably surprised to hear that, the cost of rentership, the cost of housing continues to climb and drastically outpace income growth. But I would guess that there's probably not many here in this meeting who really understand and how dramatic of a crisis we're in and how quickly this is growing and compounding. So right now, according to Adam Data Solutions, most Americans and a growing percentage of Americans, workforce, Americans living in working, doctors or not doctors, but nurses, police officers, social workers, those working in local government. Many of the people make up the majority of our local communities and workforce simply cannot afford to own a home, and in many cases are struggling to afford even finding a place it's reasonable to rent. The cost of housing continues to climb both for home ownership as well as for rentership at record-breaking paces, while incomes simply are not. What's making things even worse is some of the other dynamics that are affecting the ability to create additional housing and the amount of affordable housing that's actually being removed in many of the markets that we're in today, which I'll talk a bit more of. So here's a few stats that I think are interesting. So the affordability crisis on workforce housing. First, over 12 million Americans, which is essentially 1 out of every 4 renters in America now spend more than half of their income, more than half of their gross income each month on rent. That rate has increased by more than 30% in the past 5 years alone. So think about that. So a quarter of Americans are spending half of their gross income on rent alone. Obviously, that does not leave enough money to cover all your other basic and essential needs. Over 50% of renters today are considered cost burdened, meaning a significant larger amount of 30% or more of all of their gross income is going towards their housing expense. So they're burdened and having to restrict their ability to provide food for their family, take care of basic health care, let alone being able to save or get ahead. Roughly 500,000 housing units in America today that are affordable for the local workforce are being removed from the pool of affordable homes each and every year. And when we say being removed from the pool of affordable housing, we mean where the cost of that housing is less than 30% of the area median income. That's kind of generally accepted good number, that if your income is at a little over 3 times your rent, meaning your cost of housing is 30% or less than what your income is, that's generally a place that most people can afford and still take care of their basic needs and be able to save a little bit of money, prepare for education, etc. And roughly 500,000 units a year, a significant amount of the housing supply that is affordable today that falls below 30% of the local workforce income, is being removed each year. And that's a mix of it literally being demolished and new product being built, investors coming in and drastically renovating the asset and driving up the rents out of the affordability pool, properties being condemned because they're not being taken care of, and a variety of other causes. But those are some of the real big ones that's actually removing the number of affordable housing units. Subsidized housing, which is the government subsidizing developers and operators, and subsidizing renters as well who can't afford local housing costs, has remained flat. So there's not an increase in subsidized housing, and that might be surprising to some. That's remained completely flat over the last couple decades. So the government or any subsidies are not making up for the loss of housing, let alone the fact that the demand is growing and there's not new supply coming into most markets, which we'll talk more about. What's interesting, I think, to many is that the demand for affordable workforce housing, is actually growing the greatest by far by those over 55 years old. So in the last a decade alone, the demand for affordable rentals for those over 55 has gone up by over 30%, meaning more and more people in the older age brackets, but from 55 to 65, as well as 65 plus, are now choosing or not having a choice, and are looking to rent, and are in a financial position where they need, affordable workforce housing, and there simply is not enough supply. So there's not a single county today in America where there is enough housing for low income or workforce housing families. Right now, there are 46 million Americans who live in what's considered the poverty level. This number has increased by over 38% in the last 13 years alone. We're at the highest rate in 60 years. 15 million children, 21% of all children, live in families with incomes below the federal poverty level. Millions of Americans are simply struggling to find an affordable place to live. In order to afford a modest two-bedroom apartment in the average U.S. city, renters would need to earn $20.30 per hour. Right now, there's 500,000 veterans who are homeless in the U.S., with 1.4 million at risk of homelessness due to poverty, a lack of support systems, and poor living conditions, lack of affordable places to live in many cases. To make things worse, as you look here at these charts, there's a projected 4 to 4.9 million additional renter households expected between now and 2025. So meaning the demand for housing for renters is growing dramatically. So right now, 43.5 million renter households in the U.S. That's going to go up by about 10% in the next 4 years alone, while the supply of the existing affordable housing stock is declining. This here gives a little bit of insight here of the affordability crisis in terms of how it affects their other expenses, and people are having to literally trade off. Those in the light blue, the colors on the right, are those who are spending more than 50% of their income on rent, and you see how much less money they have to spend on essentials like food, healthcare, and retirement. So think about that. A family who's spending more than 50% of their rent, it has a $224 budget a month to cover all their food needs. Think about that. $44 a month to cover all their healthcare needs. They can't take care of their basic necessities. And then what makes the situation even worse, you would think, well, in a capitalistic country like we all are blessed to live in here, well, you would just create more housing, right? This amazing demand that I just have built the case for the need for affordable workforce housing, that would lead us to going out and building more workforce housing. Well, the average cost today of a brand new apartment or home, a rental home, whether it's a multifamily or single family home, the average works out to be $195,000 is what it costs to develop and build a new multifamily or single family unit in America today. So if I came to all of you and said, all right, we're going to go and we're going to build brand new apartments to help tackle this issue, in order to keep that unit at 30% of the household income, we'd be able to generate a 2.9% cap rate. Meaning if we made this investment with no leverage, we would get a 2.9% return on investment. How many of you would be real excited to invest with us if we were able to generate a 2.9% gross return on our money? Obviously, I don't think any of you would even be on this webinar if those were the kind of returns we were able to generate. But the reality is, in order to make financial sense of building brand new apartments at $195,000 cost, you need your average rent to be somewhere in the neighborhood of $1,300 to $2,000 a month, depending on a variety of variables, which in most locations, that's not affordable for the local workforce. So it's a major problem that can't be solved simply through the development of additional units, because the growing construction costs, development costs have made it nearly impossible to build affordable units. So on top of the challenge of pre-COVID of workforce housing, and the challenges pre-COVID of technology and innovation that's causing a lot of jobs to be lost. COVID-19 outbreak here this past year has only grown the magnitude of those in need of good income that can provide the level of income needed to cover basic housing needs. So some estimate that over 13 million, by the most recent estimates, over 13 million low-income renter households have been significantly affected from COVID-19 this past year. And obviously, there's some different aid and such that has gone out related to that, as we all know, through the CARES Act. But it's only compounded the issue that there's less and less jobs in a lot of markets that can provide the incomes to support the growing cost of housing. So we're focused on making an impact here. Obviously, this is a bigger problem than we're going to be able to completely solve here together at DLP, but we're focused on making an impact on it through the way we invest here into the communities and throughout the U.S. Through our investment funds and our business, as well as through our foundation called the Dlp Positive Returns Foundation that we'll be talking a bit about at our upcoming gala event. You can join us in a few weeks, which I'll highlight towards the end here. So the way we focus on making an impact on this crisis or these crises are by coming in and acquiring properties that are affordable for the local workforce, making physical improvements, improving the management, ensuring that we have the right residents who take pride in their homes, making the community safer, providing housing, and in turn providing housing that's affordable for the local workforce, bring enrichment programs to our residents that can impact their quality of life, such as enrichment programs around health, education, career advancement, and helping them grow their savings. And we're doing a lot of these things now, and we're in an active process of developing and formalizing some of these enrichment programs throughout our entire portfolio today. We come into these communities and we focus on delivering wow and retaining our residents, improving the physical assets, reducing our operating expenses for us as the owners, as well as for our residents through green improvements, through preventative maintenance, as well as through lower turnover costs, because the residents aren't moving out as often. It lowers our costs as owners, and it also dramatically affects the residents. One of their biggest costs is constantly moving and paying additional security deposits and moving costs and so forth, as the average American resident moves every 14 to 18 months. We're focused on improving our apartments and the lifestyles through improving the units they live in, adding amenities such as playgrounds and dog parks and fitness equipment and community gathering spaces and community events. And while doing all this, still keeping the homes, the apartments affordable. And that's a big focus. Our portfolio today, our average rent is about $850 a month. And we want to make sure we focus on not taking the approach, even though at times it certainly can be profitable to come into these types of communities we acquire and go and spend $30,000, $40,000 an apartment on interior upgrades and renovations. We can get a good return doing that and drive up our rents then to $1,200, $1,300, $1,400 a month. There's a lot of great real estate operators who that's exactly what they do. But then in turn, they're taking these units out of the affordability pool in that local community. So we certainly want to maximize our investments here, but while taking an approach of keeping the unit affordable through a number of these efforts that I've gone over here on this slide and the past slide, focusing on lowering operating costs, lowering turnover, that'll help us to run the communities more efficient, and in turn help our residents as well. So let me give you a few examples of some of our recent investments and the upcoming investments that are going to make an impact in these local communities. So this was a community. This is our last larger community we acquired late in 2020. That'll change by next time I talk with you. We'll have some even newer acquisitions that I'll talk about coming up here. But this community here is called Pepper Tree, and it's in Charleston, South Carolina. And these apartments were built between 1983 and 1989, and we're targeting an 18% return on investment here. So we're not coming out here and even though we are making an impact on this affordable housing crisis, we're still making great returns. We came into this community with the average rents of about $1 a square foot. Next slide has it. It's 800 and let me just skip ahead to remember here. $843 a month is the average rent today or at acquisition on this community. So we're going to come in here and we're going to improve the community, improve the curb appeal, improve the quality of the unit. We're adding air conditioning throughout the community, which it doesn't have today, which is tough in Charleston as it gets quite hot. Improve the units to look more like what you see on the left from what it currently looks on the right. So we're going through, the previous ownership had renovated about 60 units. We're going to go through and renovate the rest, helping make the apartment more functional, as well as more attractive to attract, good residents, good families, make them proud to bring their friends over, and be happy to stay in this community, and build relationships with local residents, have their kids build relationships within the community, be engaged in the community and the events and the activities and the enrichment programs that we're doing and expanding as we speak. This is a community we bought we put in about $10 million equity investment. It was about a $30 million total investment. As mentioned before, 18% annual IRR is the target. We expect to generate over 9% current cash on cash returns, while being very tax advantageous and making a great impact in keeping this community affordable for the 300 plus families living in this property right now. Here's some more lights. So we are bringing up the rents in this case. We are doing a lot of renovations, adding central air. We're going to go from $843 to $967, but in Charleston, $967 a month is still very affordable. We're still in the low 20% affordability. So I said before, affordable is the generally thought to be affordable if it's less than 30% of the average area median income. So we're at about 23% here, meaning only 23% of the income of the average family would be spent on the rent, which means they'll have excess money to take care of education, savings, healthcare, food, etc. Some of the acquisitions we have coming up. So we're expecting to close this portfolio next Friday. This is 1,086 apartments in Mississippi and Alabama. These communities are built between 1989 and 2006. Most of them built in the 1996 to 2006. The rents currently on this portfolio are $866 a month to $970 a month. Our in-place affordability is 22%. So again, only 22% of the average area median income is going towards rent. Less than 0.25% versus many Americans today now spending over 50% of their income. So big difference when only 1/4 of your income is going to your rent than when 50% of your income is going towards your rent. Even as we drive and improve these communities, will still stay sub 25% affordability. That's a big deal, while investing in really nice assets that are performing well. You see the quality of these assets here: nice amenities, nice community space, really excellent assets. Really great example of what we're investing in, what we anticipate investing more in as we continue our growth. These communities we already manage today, and we already have a minority interest in them today, and we are going to own them 100% as of, we expect, next Friday. So it gives you a little feel of those communities. Right behind that, we're expecting March 12th, we're going to be closing on 2 communities in Kentucky, in Paducah and Owensboro, Kentucky. These communities are even newer. They're built in 2014 and 2016. Really nice, high quality assets, as you can see from these pictures. Great amenities, pools, car wash, dog parks, really nice community space, nice gyms, really nice high quality units and finishes. But despite, garages, but despite how nice these units are, as you can tell here in these pictures, we're still very affordable. So $850 a month for Paducah and $887 a month in Owensboro are the in-place rents at acquisition. With those rents and modest expectations to growing rents, we're targeting a little over 20% IRR over the course of our investments here. We're going to come here and add washer and dryers and add valet trash, improve the experience and the amenities for our residents, and be able to generate very solid cash flow, very solid returns with modest growth. Owensboro taking the rents from $887 up to $899. In Paducah, $851 to $866. So really great assets, going to keep these communities affordable, continue to build upon providing great services and management. We actually acquire a great team at both of these properties. And we expect we'll own these assets, long term and provide a great impact in these local communities. Right behind that, we have a community we're finalizing. It's a long story, but fell out of contract, working to get back under contract here, hopefully in the next day or two, in Myrtle Beach. Very similar, falls right in line. This was built in 2000. And right now in total in our Dlp Housing Fund, we own 23 communities, over 6,000 apartments, rental homes that fall right in line with what we've been talking about here, owned currently. Again, primarily, if not 100%, workforce housing communities. Those assets are all owned in the $1 billion evergreen Dlp Housing Fund. This is our 8th fund that we've launched. It's our only equity fund today. It's our only fund that's investing equity into these types of rental communities, these workforce housing communities, focusing on improving them, making an impact, continuing to provide safe, affordable housing while focusing on providing enrichment services and value to our residents. Our primary strategy here with the Dlp Housing Fund is positively impacting the workforce housing crisis in America. We expect as we grow this fund, we're a little distance away from this right now with 6,000 units and about 16 or 17,000 residents in the fund. We're going to scale this fund over the years ahead as this is an evergreen fund. We expect to continue to grow. We expect to grow this fund to 100,000 housing units, providing housing to affordable housing to more than 250,000 residents. Pretty big goals for sure. This shows you where on a map our communities are located, generally secondary and tertiary markets, but with good job growth, good population growth, where we can make an impact and provide, again, safe, affordable housing to local workforce. Some highlights on the fund is an evergreen open-ended fund that will continue to grow. We value the fund every year. The valuations for 2020 come out in just a few weeks. Don't yet have the final valuations back from our third-party valuation firm, but I've seen draft numbers, and I'm very confident that investors are going to be happy with our first year's performance here in the Dlp Housing Fund. Phenomenal tax shelter. So while making a great impact, while generating monthly cash flow options, while generating double-digit returns, we're sheltering those returns from tax. So overall highlights to the Dlp Housing Fund, our only fund that invests equity in workforce housing communities. 12% overall return targets is the target of the fund on an annual basis. 6% preferred return. That means you earn 6% before we earn anything, even our management fee, which is very unique. You have the option of taking those distributions every month. Even though this is an evergreen fund, we expect to grow for many, many years, if not decades ahead. You have the ability to exit this fund each year. You'll have a window you can choose to redeem out of the fund in part or in whole, so you don't have to make any long-term commitments to the strategy or the fund. Historically, we've acquired 11,300 units over the past 4 years. Over this year and the following 3 years, we expect we're going to acquire over 25,000 units, be able to provide housing to somewhere in the neighborhood of 60 to 70,000 residents. There's a great opportunity here to do so. I laid out some of the facts and some of the stats on the dramatic need for workforce housing today in America. But from a financial standpoint, the opportunity today is pretty incredible. Even last year, in the midst of the global pandemic, the Class A asset class, the assets that generally are not affordable for local workforce, the $1,500 a month apartments, the $2,000 a month apartments, saw a decline in rents in 2020. In Class B, rents went up just under 1%. In Class C, meaning even more affordable, rents went up nearly 2%. So rent have remained very, very strong and consistent, even in difficult times, as the demand is just so high. We're at all-time high demand for affordable workforce housing in almost every market. National vacancy is at near all-time lows. And again, there's almost no new construction being built in any markets in the country today that's truly affordable for the local workforce. Um, right now, again, there's 43.5 million renter households in America, at 36% of all households. Not only is the percentage of households that are renters instead of owners expected to continue to grow, the number of households is growing, and there's expected to be 4 to 4.9 million additional rental households, meaning another 12 to 15 million Americans will be renting instead of owning over the next 4+ years alone. Tackle on top of that 500,000 plus units today that are available in the rental pool that are considered affordable will no longer be affordable or will no longer exist each year for the foreseeable future. So that's over 2 million units today that where the cost of rent is less than 30% of the area median income will be gone in the next 4 years alone, compounding this issue and creating a great safety net for investments in this strategy, as simply there's dramatically more demand than there is supply. We're focused on investing in markets that have growing, even more growing demand because there's population and job growth. And even with COVID-19, there were growing vacancy rates in some of the luxury space, but in Class B, Class C, in the workforce housing space, vacancy rates have remained at all-time lows, or at least near all-time lows, in almost every market. In addition, great interest rates are helping keep demand really high, both on the home ownership side and on the investor side as well, which is continuing to drive up the value of homes, continuing to drive up the value of multifamily properties as supply remains incredibly constrained. So when the value proposition to invest in this asset class is so strong, when the demand is so high, it's obviously not easy to find great deals, and that's a big focus here at DLP. It's been a big focus for many years. We have built our ability and our relationships to source off-market and lightly marketed deals directly with relationships with owners, lenders, special servicers, and brokers through our sales team and our sphere of influence. Keep in mind, despite how great this asset class is doing, there's always individuals. There's always distress, right? We're not buying every time we go out and buy a community. We're not buying a market. We're buying a deal, and there's always ownership disputes. There's always financial distress. There's death. There's divorce. There's a million different challenges of what can lead to distress and a need for somebody to sell an asset, and for us to be able to capitalize and create a solution for that person who needs to exit, and in many cases, as we buy, needs to exit quickly and generate great above market returns. We source a lot of our deals as well through a growing network of elite operators, that great real estate operators who we often lend to, that we also partner with and provide them with priority JV equity. And we're constantly looking for inefficient markets, in ways to go out and find value and create value. As an example, our most recent deal we put under contract is currently run as a student housing community. And we're seeing a lot of distress in student housing due to a lot of the university and college shutdowns and work from homes, or attending school from home. And a lot of these local student housing communities have seen a major decline in turn in occupancy. And a lot of the operators who invest as student housing operators are struggling, and we're finding distress in a lot of markets due to COVID, that we're able to come in and acquire assets that are currently being run as student housing and convert to more of a market rate multifamily community, and be able to acquire assets at a great discount. Strategy that I don't think many have started looking at, that's created in this unique, inefficient environment caused by COVID. It's one of the examples of strategies we have here in 2021, and in some of the markets where these COVID restrictions may continue longer, is going to create a lot more distress and great opportunity for us. So what we invest in is in summary here is we're targeting communities that are affordable, rents that are less than 30% of the area median income, in markets with solid population and job growth. We focus on being in markets with at least a $35,000 area median income. We target predominantly secondary and tertiary markets of at least 50,000 people. So we don't want to be in a tiny rural market where there's going to be, could be some challenges if, one employer leaves or goes out of business. But 50,000 plus markets and where that have good job growth and good population growth. Primarily, we're focused on 1990s or newer construction. Primarily, we're focused on communities of at least 200 units in size, so that we can staff those communities correctly, have the amenities to really provide, great resident and community services. And we're focused on investing where we can generate at least a 7% cap rate or a 7% stabilized yield, meaning without leverage, we're at least a 7% return on investment at minimum. And in this competitive market where deals are often trading or selling at sub 5% cap rates, in many cases sub 4%, that's never been harder to do, but I'm proud to say we're consistently still doing it. In turn, that means with today's great interest rates, we're able to generate really, really solid cash on cash returns, as well as overall IRRs. So how we go about mitigating risk in our strategy here and investing in these workforce housing communities is heavy financial underwriting, deep on-site inspections of all the units. We walk every unit, the entire property. We do complete market studies on the local market, on the competition. We do full environmental reports, engineering reports, crime research. We estimate over 2,000 hours of due diligence and underwriting go into each and every one of our acquisitions, in addition to the thousands and thousands of hours we spend on the deals we don't end up buying. We stay very focused on value. The same asset, I think this is something people often can forget, despite how great this asset class is, despite how great this time it is to be investing in workforce housing with the amazing demand, still an asset can be a great investment at one price and a terrible investment at another price. So price value is really critical. We focus on investing in assets where, as we stabilize it, we can generate double-digit cash on cash returns. We focus on generating at least a 17% IRR on the asset level, assuming a 5%, a 5-year exit in most cases, assuming very conservative rent growth, assuming very conservative exit cap rates, meaning what the value will be when we sell the asset. We use non-recourse long-term financing. We do active hands-on management, which is really important, with a heavy focus on resident retention, a heavy focus on addressing all capital improvements, especially those related to emergency or critical repairs, and then also keeping the units affordable. So that's a lot of information on the housing fund. I'm going to wrap up here as we open up to questions with our lending side of our business. And an important distinction here is this our lending strategy, albeit we're not the owner investing in these assets. In the majority of cases, we're sitting on the lending side. We're predominantly lending money to other real estate operators who have similar strategies to us. The underlying assets that we're making loans on, the vast majority of the time, are also workforce housing units. Sometimes those are for sale, but the majority of the times they are for rent. So we are making an impact on this same crisis of affordable workforce housing on the lending side here in our DLP Lending Fund, Income and Growth Fund, and Positive Note Fund. Our DLP Lending Fund generates a 10% plus annual return with monthly distributions, a 10% preferred return that's paid to you before we earn anything, and then it's an 80-20 split above that 10% return. We've generated over a 13% return since we launched this fund 7 years ago. Even through COVID, as we've been sitting on more cash, been even more conservative, we've continued to generate over 11% returns every single month, annualized returns every single month since we started the fund. The DLP Positive Note Fund is another opportunity for you to invest in our lending strategy. Instead of being a partner, like I just described in the lending fund, a limited partner, you can actually be a lender lending to the fund that's making loans predominantly backed by workforce housing investments and get a fixed return on your investment ranging from 5 to 10%, depending on how much money you choose to invest and if you choose to commit just for 90 days or as long as 5 years. And then lastly, we have our Income and Growth Fund, which is very similar to the lending fund, very, very similar returns. It's been generating slightly higher returns than the lending fund, but a similar fund to our lending strategy, again, making loans backed by generally workforce housing assets, communities, and portfolios. All right, so last couple items, you can see the performance here been a little bit higher than that of the lending fund. So last couple items before I open it up here to all the questions I see typed in. So I want to highlight. So and Larry and Rich, I know we're gonna smile as I say this, but as over the every day here at DLP, we spend a lot of time and effort and energy to not only generate strong returns and make an impact on our investments, but we also really focus on providing great service to our investors, something we pride ourselves in. And I can tell you 99 out of every 100 times anybody contacts us with anything to complain about or be upset about or want to discuss is always around deployment. So at least 99 out of 100 times the comment is about deployment. And people want their money deployed into these kind of returns quickly, and we understand that. So great news is right now we have phenomenal deal volume. I walked you through on the Dlp Housing Fund. We expect all of those assets I showed you, plus another community that wasn't listed there called Vantage at Germantown in Germantown, a suburb of Memphis, will be closing here, we expect, between next Friday and end of March. So between next Friday and end of March, we're going to be closing on over, let me do the math in my head real quick, over 1,900 new apartments. So we're gonna have a phenomenal deployment of capital. And in our lending fund and income and growth fund, we've been deploying capital pretty efficiently. Income and growth fund is deploying capital faster than lending fund. But both funds have been deploying capital quickly. Historically, it's taken us 6 to as long as 90 days. I think our average historically has been between 20 and 30 days to deploy all of your capital. So reminder, when you make an investment with us, your money goes into a subscription account, and it doesn't start earning returns until we are able to deploy it. We'll always do our best to give you some guidance to what we think, but we can never predict exactly how long it'll take because we're investing in real estate deals and we don't get to choose when they close a lot of cases. So deals get delayed, they get postponed, they get canceled, and we can't deploy your capital until we have a deal to deploy your capital into. Great quote here. It says, "A man watches his pear tree day after day, impatient for the ripening of the fruit. Let him attempt to force the process, and he may spoil both fruit and tree. But let him patiently wait, and the ripe pear at length falls into his lap." And just a little kind of example here. If you invest in our DLP Housing Fund, this is the amount of money you quote unquote give up or lose as an alternative by waiting 30 days, 60 days, 90 days. It's generally, very small amount of money. And you see the difference between what you're earning in bonds or savings accounts on a monthly basis versus, what you're going to earn once your money's deployed here into the housing fund. So we recognize that everybody would like to be deployed right away, but get on the waiting list. Once you sign your documents, that's when you get on the list for deployment. Sooner you sign, sooner you get deployed. We're blessed and thankful that we got great demand for our investment funds, and that capital is coming in just slightly faster than we're able to deploy it. We are deploying it. We're in midst of our greatest and largest lending month ever by a good margin. Knock on wood, we'll conclude by far our greatest month of lending ever. March will very likely be our largest acquisition month ever. So we are doing a great job of growing our deployment, growing our investments while not sacrificing yields. All right. So with that said, before I open up to questions, you can reach out to any of these smiling gentlemen here, whoever you're already working with. If you're not working with any of us yet, you can reach out to any of my associates here on the screen, and they'll connect with you, talk about your specific situation, chat further. And then you can also go to our investor portal, which will send you a link to dlpinvest.com, and you can review all of our financials, past performance, audits, et cetera, as well. And then I think my last slide here before I open up to our questions, a reminder here, we're coming down to the kind of deadline to be able to join us live at our upcoming gala events. We're doing a live on-site gala event in St. Simons Island, dinner event on March 18th. And you'll be able to join us on that portion, that dinner event via Zoom if you can't join us live in St. Simons. And then all weekend long, we'll be doing a prosperity, we call our prosperity workshop mastermind event, as well as an inner circle retreat. So if you're interested in joining us live for the Thursday dinner, you can go right there to the link. We'll drop it in the chat box as well, dlpcapitalpartners.com/St. Simons. Join us either for the Thursday night dinner live. You can't join us live, join us on Zoom. We're doing some cool things, including doing a silent auction for the DLP Positive Returns Foundation, giving away vacations and some pretty cool things, such as, golfing with Davis Love and some other cool things. And if you're able and you're interested, apply to come join us for the whole weekend. We're going to have some amazing world-class speakers at the conference. We're going to be golfing with Davis Love, famous top golfer. He's going to be also delivering a really cool speech as well. So it's going to be a really fun time. At the gala dinner event, we're going to have live dueling pianos. We're going to be raffling off again sports events, some tickets to sporting events, celebrity memorabilia, family experiences, a lot of cool things. So go to that link there, and we'll be emailing you all this. I'm sure you've already seen the emails on it, but we'll be following up to everybody here with emails as well with more info. But literally for the live event weekend, we're literally running out of space. We have a certain amount of space we can have at the dinner events as well as the weekend events due to COVID. And this is not a sales pitch to say we literally only have a few for those joining the weekend, a few hotel rooms left. But hope you're able to join us. It's going to be a lot of fun for sure. All right. And then we'll continue with these market updates and overviews and insights on what's happening here at DLP in the weeks and months ahead. So you can always join us these events. Register at dlpcapitalpartners.com, and you'll get our emails if you're here with us now. You'll continue to get our emails to join us here again. So let's go ahead and open it up here to questions. So I'll turn it to you guys, Rich and Larry, to start tackling.
Awesome. Great job. Thank you very much, Don. So I'm going to start off with a couple of questions from Chuck. And the first one is going to be about our partner in the Pepper Tree acquisition. Just if you can tell us a little bit about who they are.
Yeah, so our partners in Pepper Tree is an example of one of our high quality real estate operators. This partner owns around 2,000 units. They manage around 3,000 units. They own predominantly in the Carolinas and Georgia region. Came to us through one of our sales guys. They had tied this deal up in an off-market situation at we felt a pretty great discount, and came to us wanting an equity partner that could provide the majority of the equity, while also looking to build a pragmatic relationship that we can do future deals with. They've been doing an excellent job going through. They're the actual doing the on-site management and construction, but we're working with them, helping them with marketing, helping with overall property management execution. We're asset managing the property at DLP, and we're also helping them with executing and maximizing the construction value add side as well. So Melanie, our president of property management, has been out to the property 3 or 4 times since we closed, as well as Chris, who's our head of pre-construction, and providing them with a lot of support and guidance and suppliers and helping them, drive the biggest value in that property. And what we love about that, and I didn't spend a lot of time on this, but I mentioned on the onset the fact that we're making an impact on this crisis of workforce housing, and I think I laid that out in pretty good detail here. But we're also making a incredible impact on the jobs crisis, and that's a huge passion of why I recently, wrote. I don't know if you guys can see it, but wrote, this book, Building an Elite Organization, which I'm excited to say will be out on Amazon and Audible and so forth on April 6th. But why we're focused on, and a big part of why we're doing this upcoming event I just mentioned is we're helping entrepreneurial companies and most specifically real estate companies to scale their business. And so we spend a lot of time helping them implement our elite execution system, helping them hire, develop leadership, grow their organization in a disciplined manner. And then by us being able to provide them with debt and then invest equity with them, we're able to help them scale their business, hire more people, deploy and hire more vendors and contractors, as well, help them grow their businesses, and makes a dramatic impact. So we see that as a big focus of ours is through our lending side of our business, as well as our joint venture program, being able to help a lot of great businesses grow through deploying capital and providing education, consulting, support, and systems to them as well.
Great. Excellent. Thank you very much. I'm going to follow up with Chuck's next question, which was now taking us from partners on the acquisitions to the sellers. And his specific question is if you can tell us a little bit about the sellers and why they're selling to us and providing these great deals that are providing such great IRRs for the fund and for investors.
So the types of deals we buy and the situations for sellers, vary very greatly. We very often, I'd say rough number is we buy a third of our deals in some sort of true financial distress where the property's been, taken over by the lender. It's been, taken over by a special servicer. They're in some sort of financial distress. And, I think it's worth mentioning here that we kind of make things, our returns are so consistent, and the way we describe everything, we make it sometimes look like it's easy. Managing a 300 unit workforce housing community, it's not easy. You're dealing with 300 families. You're dealing with people losing jobs. You're dealing with physical asset problems. You're dealing with, unfortunately, sometimes crime. You're dealing with a lot of challenges and logistics. It's not easy. And a lot of people go out and they raise, a few $1 million from some family and friends, and they go out and buy a community. They don't realize how hard it is to really execute on these types of assets. It's not, we're not investing in triple net leases where we just sit back and collect, rent checks from CVS every month. This is hands-on management. And so there's a variety of reasons why people fail at executing, and we're able to step in. And that's often, where a good amount of our deals come from. Sometimes we're dealing with, those just under urgency for a variety of reasons. Some good reasons. Hey, they got a great deal they need to go into. So a common situation for us is somebody accepts a higher offer than our offer on their property. They go out and buy another property. They go under contract. They go hard on that acquisition, and then their buyer falls out on their sale. And now all of a sudden they need to close really quick, and we can step in and move fast, and get a discount for doing so. Another reason, we get deals we at good prices is we're more focused on value than we are in engineering returns. So, example, in that deal in Pepper Tree, as well as the upcoming acquisitions in Kentucky, we're buying these assets with an assumption of existing debt. And so we're assuming existing loans in all of those cases, actually with Fannie Mae, where there's no interest only period. There's lower leverage than what we could get if we went out and put a new loan on it. And so many operators are so focused on getting the biggest cash flow right away that they're willing to pay more and put on higher leverage, get an interest only period where they're not paying any principal on their loan. And if they can't get max leverage and they can't get interest only, meaning where they don't have to pay any money against their principal every month, they're not interested. And so when deals require you to assume the existing loan, I would estimate 80 to 90% of the buyer pool is gone because they want max leverage and they want interest only so they can financially engineer returns. We're much more focused on getting the lowest overall price, the best value on the asset, not focused on certainly we want great cash on cash returns, but we're more focused in the overall return of the investment. Large portfolio that you guys, some of we were talking about and we were working to acquire a few months ago. There was a situation of the owners were very wealthy individuals, but they had most of their wealth in the energy markets and were facing, a tremendous amount of challenge and stress due to, a number of the challenges in energy and oil, and needed liquidity very, very quickly to plug some holes in where they needed cash. And other aspects of their portfolio. Some of the deals we've looked at, the operators are heavily in hospitality and they're getting, hammered in their hospitality portfolio. So they're looking to their multifamily portfolio to quickly pull cash out. So there's a variety of different personal and financial and asset related issues that can create, opportunities to buy at what we determine to be under market value.
Awesome. Thanks, Don. We'll keep going here on the property side. Kevin here has a question specifically regarding geography. So with the history of storm damage in the Gulf Coast areas specifically, is it wise to invest so heavily in those areas?
Yeah, it's a great question. I mean, look, who would have thought we were going to get a gigantic snowstorm in Texas and power be out for days, right? That wasn't in many people's model as the risk you're facing in Texas in investment, right? So, yeah, there's environmental and natural disasters, certainly all over the country, and certainly anywhere closer to coastal markets, you're exposed to more of those risks. What I'd say is, the positive side of the markets we choose to invest in first and foremost is, this isn't a surprise to anybody here that more and more Americans want to live in warm climates and coastal markets, and more companies are relocating to warm climates and coastal markets. So, so it's a place where you want to be, from a demand standpoint, which is the biggest driver to your returns and protections in most investments, certainly in this strategy. In addition, we mitigate that risk through great diversification. So, we don't have 5,000 units in the Gulf Coast. We don't have 100% of our portfolio in one state or one market. We own communities today in, I believe, 21 states, and once we close on a couple of our upcoming acquisitions, we'll be in 23 different states. So yes, the majority are throughout the Sun Belt and in coastal markets, but in a very diverse area. And then lastly, I'll say that and largely because of the diversity of our portfolio, we're able to get really great insurance. And every time that we do deal with a natural disaster, from a financial standpoint, it works out just fine. Frankly, in the example in the Gulf Coast portfolio that we're acquiring right now, 2 of those communities got hit a few months ago, and we're replacing all the roofs. And we're not having to spend money to replace the roofs. And these roofs were anywhere, these communities were built in the early 2000s. So these roofs were going to need to get replaced at some point in the near future. And we're getting them replaced now at our insurance carrier's cost. So we've never had a financial loss related to a storm. It's a lot of work that we have to deal with, and displacement of residents and so forth. It's not something we look forward to or want to happen. But when it does happen, we have the right insurance coverage in place, and it works out fine financially. But it's a fair point. It's definitely something that we look at and evaluate in each acquisition.
Awesome. Thanks, Don. A question from Robert here regarding 1031s. He says, I heard there may be consideration to receive 1031 exchange funds into the housing fund ultimately. Can you speak to any updates on this?
Yeah, thank you for that question. So I don't have any updates on it today. We are working on, being able to create a clear way to be able to move 1031 proceeds into the housing fund. But it's the short answer is it's complicated, and we've been working on it for some time, still working on it with our tax experts, figuring out a good way to do so that works for the fund and works for you and gives you flexibility in terms of the commitment you have to make. Then it's kind of gets complicated when you're transferring into a fund, and there's certain kind of tricks to be able to do it that we're working on how to best structure it. So hopeful we'll have a great solution there in the near future, but right now we don't yet.
Excellent. So a couple of quick ones here, just to get us wrapped up as we're almost ending the hour. One, what do you see as the biggest risk to invested capital in DLP over the next 10 years?
So, the biggest risk, I'd say, so the risk of, depends on of course, how you define risk. For me, risk is, the risk of losing my money. So I feel very confident to say that there is no significant risk of capital loss in our funds. Doesn't mean doomsday comes along in the world, we're in the greatest, depression in history, that it can't happen. There's risk in every investment. So I'll make that clear. But we feel very confident in the strategies we're investing in and how we do so, that the risk of principal loss is we feel as low as virtually anywhere you can put your money. I think the risk is, if we're in a heavy recessionary environment, is illiquidity. So one of our greatest values to our funds, all of our funds, is compared to most private investments, they're very liquid. So if we were in an incredible recessionary, volatile environment, and property values plummeted, and real estate was at a low point, demand wasn't there from investors, what we're simply going to do is we're not going to be selling assets. So we wouldn't be selling assets at big losses, because it doesn't make sense to do so. And since we own assets that are generating great cash flow, and I feel very confident even in recessionary environments that the demand for our housing is going to go up, not down, we're going to continue to be able to generate great cash flow in volatile and recessionary times. But if property values are low, we may not be able to exit assets at that point in time, which could create liquidity challenges. We've never had liquidity challenges. We're not certainly not expecting that, but that's I'd say the the bigger kind of practical doomsday risk of is, hey, we can't exit you out as quickly as we normally could. But my belief is from a practical standpoint, that's a good thing that we're not redeeming you out at the wrong time when pricing is low. And why would you want to exit out of investments that are generating you still great cash flow? But certainly when things get volatile and scary, people natural reaction is to grab all my money and stick it under the mattress, and fear takes over and logic goes out. And that's kind of I'd say the biggest potential risk is that somewhat level of illiquidity for if we're in a heavy volatile time.
Perfect. Thank you. And Kevin says he appreciates the answer. Great answer. And then one last rhetorical softball question for you, just to wrap us up here. What's the average timing of deployment for the Positive Note Fund?
0 days. So when you invest in the Positive Note Fund, you're deployed the day you invest.
Excellent. So I wanted investors to know that. Thank you all for joining us. Thank you, Don. Hope everyone has an opportunity to join us in March in St. Simon's Islands, and hope everyone has a blessed rest of the week.
Awesome. Thank you, everybody.